All right, everyone. I think we're going to get started. I just wanted to say thank you for everyone for joining us today. Part 3 of a 4-part series on the value of a CPA, an estate planning attorney, and a financial advisor throughout the different stages of life. Today's presentation is geared toward individuals who are maybe a little bit more established and they're looking to build their wealth or maintain their wealth. And so this would be a good presentation on those 3 different perspectives. Today's webinar is presented by Yuri Yu, Donna Lee, and Sophia Kim Sakamoto. Yuri is a certified public accountant and her office is located in Fullerton, California. Donna Lee is a certified financial planner and her office is located in the city of Orange. And me, I'm Sophia Kim Sakamoto, estate planning attorney, probate and living trusts. And we have offices in Buena Park and Mission Viejo, California. All right. Just working slides. So if you do have any questions during the presentation, there is a chat function. Go ahead and type it in there at the end of the webinar. Any questions will be answered, of course, time permitting. And you may have seen the consent when you entered into the presentation that the webinar is being recorded. And just a little disclaimer, of course, this is just general information. If you do have any specific questions, please consult with your attorney or tax professional. This does not create an attorney-client privilege. All right, so Donna, we'll start with you. And one of the questions that I always get, and I'm sure you get as well, is clients who say, okay, now we're ready to upgrade our starter home, and how much of a house can we afford? How would you answer that question, Donna?
That's a great question. How much house one can afford? It's a great exercise to run through with your financial advisor. So I'm going to run through a quick calculation with you guys. So let's think math for a bit here. Sophia, can you go to the next slide here?
Yes. Okay.
Okay, all right, see all these numbers on here. So we're just gonna go through a real quick example. Of course, every lender has different numbers that they work with and different ratios that they use. But they're always talking ratios. And one of the ratios that is commonly used is this 28%, where that's the max amount based off of your gross annual income that they feel comfortable loaning you. So we're going to go off of an example. So let's say the household gross annual income is $100,000. You're looking to buy a home that's $600,000. See if that's affordable, but how much down pay do you need to put down, things of that sort. So we take your $100,000, multiply by their ratio, 28%. That gives us $28,000. That's the max annual amount for mortgage, property tax, and insurance. Property tax is typically 1% of the property value. You may want to check. Sometimes I've seen it as high as 2%. And then for property insurance, it's usually about a couple $1,000s a year. So in this case, we just decided to use a nice round number, 8,000 here. So we're going to subtract 8,000 out, and we're left with $20,000. That's the max annual mortgage that they're comfortable that you owe. So that breaks down to $1,667 per month. Now we use a financial calculator to determine the max loan amount while not exceeding that max annual mortgage. So this is where interest rates make a really big difference. Right now, the whole hoopla is rates are really, really low right now. So you can see that if we get a 30-year loan, whether it's at 3% or 4%, you can see the loan amount is different. So the lower the interest rate, the higher the loan amount they're going to be able to give you, which is why right now a lot of people are saying it's a good time to buy because rates are really low. You can get a lot of money from the bank. So once you figure out your loan amount, anything above that is really what you need to put down as a down payment for your home. So home affordability is basically the max loan amount plus your down pay. Now, if anytime you have down pay that's less than 20% of the value of your home, then PMI applies. PMI is private mortgage insurance. It's basically another fee that gets added to the cost of your mortgage. So in this case, let's say we have a 3% rate. In the case of 3% rate, if you want to avoid PMI, you end up putting down 600,000, right? That's the price of the house, minus 395, that's the loan amount. That means you would have to come up with 205 for your down payment. And you can see that 205 out of 600, you're looking at closer to like a 33% down payment. So when people say 20% down, 20% down, it's not always the case. You have to kind of play with the numbers.
Wow, great. And I know that it's on a lot of people's minds because the interest rates are so low that they're asking, you know, can we afford to keep our old house and then rent it out? How would you respond with that?
Well, the biggest thing to note is that the lender will need to qualify you based on all of your revolving debts. So that would include, if you decide to keep your home and rent it out to buy another home, that would include the mortgage on that first home. That also includes any car loans that you may have or student loans that you may have, certain credit cards debt as well. So you must either have to have sufficient income to qualify or a large enough down payment.
But I heard that, of course, you can use your 401k funds as maybe a down payment. Do you think that's a good idea?
So your most expensive financial goal will likely be your retirement. I know homes are expensive, especially in California, but retirement is likely going to be more. So I would strongly advise against using retirement assets for a home down pay. In some cases, there are ways to access those funds without penalties, but this is just one of those cases of just because you can doesn't mean you should. A better option would be to decrease your 401k contributions and save outside of a retirement account for your home down pay.
Okay, but if I did need to, how much could I take out of my 401k toward the house?
If you absolutely need to, and you're a first-time home buyer and it's for a primary resident, you can take out $10,000. But something just to keep in mind is you will not be able to put that back in. So that's the issue with most retirement accounts is even though you might, in some cases, even if you might be able to take it out, you won't be able to put it back in. And every retirement account usually has a maximum annual contribution amount. So you're forced to be the tortoise. You have to save a little bit every single year. And if you take it out early, not always can put it back.
Okay. Right now, since the interest rates are so low, it's really tempting to buy a more expensive house. Do you think that's a good idea, even if I have student loans, to buy an expensive house and take advantage of those low mortgage rates?
That really just kind of goes back into whether you qualify or not. And it comes down to if you have enough of a down payment or a high enough income to justify another purchase. One thing I will mention, since the topic of like rentals keep coming up, is just to make sure it's worth it. And something to remember is that there's really two parts to owning a rental property. There's capital appreciation and there's income. Everybody looks at real estate in terms of what it's going to be worth in 10, 20 years. That's capital appreciation. However, sometimes they miss the income aspect. So talk to your advisor to see if the cash flow in the rental is worth it. Sometimes a property can have capital appreciation potential, but no income, or vice versa. And of course, there's also the lifestyle considerations. So beware of bad renters. California law is on the side of the tenant. So be aware of your legal rights and responsibilities. Maintenance issues. I've heard many stories of things that crazy people do. It's surprising in many cases. The ease of renting the property out, the liquidity of the asset, and even most recently with COVID, apparently we need to be concerned with any global pandemic or legislature that makes it difficult to collect rent.
Those are all good points. Assuming like I'm okay with all that, Yuri, what can you tell us about the tax aspect of having a rental property?
Yeah, there's a lot to consider on the tax side. First, I'll start with what are the tax issues of selling a home. So this is a question I get pretty often, especially when people are ready to upgrade their starter home. From a tax perspective, there's a couple of things to consider, and I talked about some of this during our last event, so I'm sorry if I'm repeating myself. But the first thing I want to mention is the Section 121 exclusion. This is where you don't have to pay tax on the gain when you sell a personal residence. So as you can see on the slide, the exclusion from gain is $250,000 if you're single, $500,000 if you're married filing a joint return. This only applies to primary residences, so it doesn't apply to like a second home or a rental, and you have to meet the ownership test. So basically you have to have lived in it out of the last 5 years. And the gain is the difference between your original purchase price and the price that you sell the property for. So for example, a couple purchased a primary residence in 2013 for $450,000. They sell it this year for $1 million. Their gain is $550,000, which is the difference between $450,000 and $1 million, of which $500,000 they can exclude from income. So their taxable gain on this sale is $50,000. So that $500,000, they're never going to pay tax on that. That's completely tax-free. So if you're going to convert a primary residence into a rental, the day you move out, that clock starts ticking. So assuming you lived in the house 2 consecutive years before moving out, now you have 3 years just to decide whether you're going to sell the house to take advantage of this exclusion or you're going to keep it as a rental. Yeah. So that's section 121. The next thing I want to talk about is section 1031, like-kind exchanges. This is where if you sell an investment property and use all of that cash to purchase another investment property of equal or greater value, you can treat it as a like-kind exchange and you get to defer the tax on the sale. This only applies to like business or investment real property. So real property is like building, homes, land, stuff like that. So an example, taxpayer purchases a commercial building in the 90s for $100,000. At some point, they do a like-kind exchange. They get rid of the building and they buy an apartment building, another building worth $1 million. They don't pay any tax. Now they want to sell the apartment building for cash of $1.5 million. Their taxable gain on the sale is going to be $1.4 million, which is the difference between the original purchase price of the first property and the sales price of the last property. So whenever cash is exchanged in a like-kind exchange, you're going to pay tax. And you can see that this is just a deferral. It's not an exclusion like 121. So this is something to consider when you're thinking about converting a property that you used to use as your personal residence into a rental, because that 121 exclusion is pretty, it's something you might want to preserve in certain cases. One last thing I want to mention about having a rental is that there are special rules when it comes to deducting rental losses. If your overall income, like from your salaries and everything else, is over $150,000 and your rental has losses, you probably can't deduct it. That's something that surprises a lot of people because you think if you have all these expenses related to this rental property that you'd be able to write them all off, but that's not always the case. You don't lose the losses. You'll be able to deduct them eventually, but it might not be until you sell the property. And just from my experience in California, rental homes with a mortgage are not generally positive, like cash flow positive, or nor do they like create any taxable income just because of the high costs. So having a rental definitely complicates your tax returns. So if this is something that, if you have a rental property or thinking about it, you probably want to consult with your accountant.
Wow, good to know. But I know that it's very popular to have rentals as property. Donna, what do you think about having this investment property, which is non-liquid, versus having liquid type of investments, such as like retirement accounts? Can you talk a little bit more about those two types of investments?
Absolutely. So it's really a question of investment property and real estate versus stocks, bonds, mutual funds, and such. So I think of this really not so much of an or question, should I get one or the other, but rather it's more of a when question. So the biggest difference between the two is the nature of its liquidity. Stocks, bonds, ETFs, funds, they're all fairly liquid. You can access them immediately, and funds will generally be in hand within a week. I will note that not necessarily for retirement accounts because there's age limits that apply and such, but for non-retirement accounts, any type of stocks, bond, ETF, mutual fund investments. They are liquid and you can get the funds within your bank account pretty much within a week. Real estate, on the other hand, is much more illiquid. So once you purchase the real estate, the money is stuck there until you sell the property or you refinance it. And ironically, if you need cash, let's say you lost your job, banks actually need to qualify you for a refinance. So it's very likely that, ironically, when you need it most, you likely will not even qualify. But even if that's not an issue and you're able to sell the property or refinance the property, it still takes a few months to actually get the funds in hand. So because of this, I would start with investing in stocks, bonds, mutual funds, ETFs first until you have a large enough asset base, large enough investment account, and then maybe portion off a part of it for illiquid purposes.
Okay, that's good to know. Yuri, from a tax standpoint, some of these investments might provide income, but is there any capital gains involved?
Yes, generally for federal tax purposes, there's two tax rates. I mean, there's really more, but we'll just say there's two for now. There's your ordinary tax rate, and that's where how most of your income is taxed, like your salaries, your interest income, your business income. Then there's the capital gains tax rate, which is lower than your ordinary tax rate and applies to sales of investments you've had for at least a year, like stocks, bonds, property, things like that. Listed on this slide are the 2020 maximum long-term capital gains tax rates. As you can see, the lowest rate is 0%, and that's for real, like you might not pay any. The highest is 20%, but most taxpayers fall in the 15% range. These income brackets adjust just a little bit every year. There's another tax to consider when you're selling investments, and that's the net investment income tax. This is a fairly new tax. It came about a couple years ago. And it's a tax of 3.8% that applies to investment income, like interest, dividends, rentals, capital gains. The net investment income tax kicks in when your overall income exceeds these limits. So $200,000 if you're single and $250,000 if you're married filing a joint return. So this is a newer tax that sometimes people aren't aware of. So just know that if you have a really big capital gain coming in, your capital gains tax might be 15 or 20, but you're going to have to tack on another 3.8% of that, or to that.
Wow,
So,
that's very interesting.
yeah.
Can I just add one thing? I'll just say as I'm looking at these rates here is that there's a lot of talk in the news right now with the elections, and depending on who wins, these rates could potentially change. So just keep that in mind when you're doing tax planning.
Mhm.
Oh yeah, rates are always changing and laws are always changing. It drives me nuts. But that's why I feel like having like relationships with professionals is really important, because I still get questions that people have about tax laws that were like from 15, 20 years ago. They don't realize that they've changed. And so it is really important to, like, you know, educate yourself and be aware of everything that's going on that might affect your taxes. I mean, not that taxes is the most important thing, but usually people don't realize until it's too late.
Absolutely.
Yeah. I mean, that's a good point, because from an estate planning perspective, that tax rate changed a lot. And so if you do have an older trust, you better get that reviewed, just because the way that they did trusts, you know, 15, 20 years ago is different than what it is now. All right. And just to throw in my 2 cents about investment properties, and just to be sure that title on real property is correct, you probably want to put it in a trust. Also, something to consider is property taxes if you pass away, how something is transferred. If it's a residential or investment property, it's different, and it could cause a property tax reassessment. And also to just have beneficiaries, the proper beneficiaries on your investment accounts. If you don't have any beneficiaries, or maybe the ones that you listed are no longer here or available, it could be in probate. So we want to avoid going through that probate court system. So if you do get an opportunity to check on your beneficiaries, just do that. Make sure. Also, if any beneficiaries are minor children, that could also cause an issue too. All right. So Donna, here's another question then. Maybe I'm okay with, you know, investing in 401ks and IRAs, and I maxed them all out. What are some other ways I can save for the future?
If you want to save more for your retirement, there are definitely some options. However, make sure that you have enough future savings first. After all, saving for the future is more than just retirement. So consider opening non-retirement investment accounts. That could basically be a catch-all bucket for you. Since there is no limits on there, there's a lot less rules that apply to those types of investments. So if you're doing that and you still want to save more, in particular for your retirement, there are a few options. Talk to your advisor about using a strategy we call the backdoor Roth, or even a super backdoor Roth. It's for people who don't typically qualify to contribute into a Roth IRA but want to. Secondly, if you're a business owner, you have the flexibility to design a retirement plan to maximize the business owner's benefits. We do this all the time. You're able to save a good amount of money into your retirement account and save a lot of tax. And lastly, you can actually put more in your 401k. So for 2020, the IRS limit for salary deferrals is $19,500. However, the maximum contribution that can go into the 401k for the year 2020 is $57,000, more if you're over the age of 50. This includes your salary deferral of $19,500, any employer match or profit sharing, and any after-tax contribution you would make. So you can essentially fill that after-tax contribution up to the max of $57,000. Keep in mind that this after-tax contribution is not the same as a Roth 401k. There's different tax implications for those, but you are able to save more into the 401k if you so choose.
Okay, well, speaking of tax, Yuri, can you tell us a little bit more about tax reporting of these backdoor Roth IRAs?
Yeah, backdoor Roths do require some extra reporting when it comes time to do your tax returns. You have to attach a Form 8606 to your tax return in the year you make the initial non-deductible contribution, and you got to do it again in the year you do the conversion. So it's just something to keep in mind. I've seen returns where people end up reporting these incorrectly, or they pay tax when they're not supposed to. And I usually do recommend that if you're doing backdoor Roths, that you're working with a financial advisor, just because they are a bit complicated and there's special rules with them, and they can kind of guide you through that stuff better than I could.
Yeah, I mean, it does sound really complex, and I feel like if you are building wealth, and the more wealth that you have, of course, things get a little bit more complex. So it's definitely a benefit to have a professional CPA, financial advisor to help with these strategies, because what you don't know, right? So it would be good to have that advice regarding these strategies, and especially when tax law changes too. So that's very good. Okay, so Donna, I'm sure you get a lot of this question, and it's like, when can I retire? And then of course, how much do I need to retire? How do you answer questions like that when clients ask you?
So there is a really quick rule of thumb. Sometimes I refer back to this chart with clients. Sophia, if you can go to the next slide. This is just a very, very quick and dirty way just to see if you're on track to retire. Kind of gives you an idea if you're saving enough, or maybe you're over saving for your retirement. And you can see that the factors are your age and your income. We'll just do a really quick example here. We'll say, where's the one that makes my math easy? We'll do this one. You're 50 years old and you make $100,000 a year. Then at this point in time, you should have about $450,000 in your retirement account to be on track. You can see that these factors increase as your income increases and as your age increases. And that has to do with your standard of living and how close you are to actually being retired and such. So this is just a quick rule just to see if you're on track. But something to be really mindful of is saving for retirement is very unique because it's different from any other goals that you're saving for. With every other goal, whether it's a house or a remodel or a car or a second vacation home or kids' college education, pretty much the goals are satisfied once you have reached a certain amount. But doing that for retirement, you're just halfway there, because now we have to make sure that you have enough money to actually last you your entire life. So we view retirement as two distinct phases. There's the accumulation phase where we're actively saving for retirement. And the goal here is growth. We're trying to grow this account as much as we can. It's a very simple, not easy, but simple concept. During the distribution phase, that's when we're starting to withdraw from these accounts and want to make sure that the money lasts your lifetime. So the concept of sequence of returns is very important here. When saving, it doesn't really matter if your account does negative 10% one year and positive 20% another year, or opposite. It doesn't really matter. However, the math does not apply when you're starting that distribution phase. Here's a table. Basically, what this table shows is the I want to say it's S&P 500 returns from the year 2000 to 2016. Portfolio A versus portfolio B, the difference is they just reversed, they did the inverse of the returns. So you can see it's negative 10, negative 11, negative 9.10, 9.1, negative 11.89, and then on the opposite, portfolio B, it just runs the opposite way, okay? So if this was in the accumulation phase, portfolio A and B would end up with the same number. The problem is when you're in the distribution phase and you're starting to take money out every single year. In this case, this person is taking out $25,000 a year out of a $500,000 account. In 17 years, the difference in the account value is about $400,000. If you multiply this out to 20 years or 30 years, if you multiply the numbers from 500,000 to a million or 2 million, the difference can be staggering. It's a difference of retiring with millions or running out of money before you actually retire. So the takeaway from this slide is because markets are volatile, we need to be careful how much we withdraw each year to make sure we don't run out of money. In this case, they're taking out 5%, $25,000 out of $500,000. Okay, so 5% is clearly too high. There is a potential to run out of money based on how volatile the markets are. And markets in general have gotten more volatile, increasingly more volatile. So that safe withdrawal rate that traditional wealth management has used has gone from 5% down to 4%. And recently I've seen it at 3.5%. It just keeps coming down. So let's look at an example on how much money you need to save to retire. So we just have an example here. Single client needs $75,000 a year gross. Just so you kind of know, it's roughly $61,000 a year net after taxes. If we use this traditional wealth management way, let's be conservative and go with a 3.5% withdrawal rate. Right, 75,000 divided by 3.5%. You need a lump sum. You need a nest egg of $2.14 million to safely withdraw 3.5% every single year to pretty much, I don't know if it's guaranteed, but close to guarantee that you won't run out of money. Okay, that's a pretty large lump sum that you need to save up for. On the other hand, this is what we do. This is a strategy that we use with our clients a lot of times, is we're just guaranteeing the fixed expenses. So the fixed expenses are the expenses that you have to live, right? The variable expenses are maybe like the vacations and such that you might take and you may not take. So for this client, same client, single client needs $75,000 a year, but 60 of that are fixed, okay? So what we would do is we would use a combination of traditional wealth management and possibly combine it with other potential financial products. So in this case, you can see it brings down that nest egg. So 60,000 is what we need. There are products out there in the marketplace right now that can guarantee a 5% income stream for the rest of your life. So that means you only need $1.2 million there to generate that 60,000 every year guaranteed. The remaining 15,000, let's say we use traditional wealth management and we do 3.5%, you need about 428,000. So altogether, you only need 1.65 million. So you can see that by using different strategies or combining different types of products, we're able to bring down how much you actually have to save for retirement.
Donna, does this account for inflation?
No, this is purely just a mathematical example here.
Mm-hmm. All right, well, I mean, that seems like a lot. right? But of course, in the grand scheme of things, we don't want to run out of money, and of course, inflation needs to take that into account. Yuri,
I will say though, some of the products, some of the financial products will have inflation built into them. So it kind of is a problem that takes care of itself.
okay. But speaking of the distribution phase, Yuri, can you talk about some of maybe the taxes that we'll encounter when it comes time to have that retirement income maybe distributed out?
Yeah, generally distributions from retirement accounts are taxed at your ordinary tax rate, except for distributions from like your Roth IRA and your Roth 401k, which are not taxed at all. So all the money you put in plus all the earnings, when you take that back out after you retire, there's no tax. So it's good to have a mix of taxable and non-taxable retirement income. Most people think that after they retire, they're going to be in a lower tax rate, but that's not always the case, especially if you're going to have income from pensions or just other taxable retirement accounts or maybe rentals or investments. A lot of the times you're going to have less deductions after you retire. You may have downsized your home, so your mortgage interest and property tax deductions are lower, or maybe your house is paid off, so there's no deductions there. The other thing is that, you know, like we mentioned before, tax rates are always changing, and right now they're very low. So your deductions just aren't worth as much today as they were like 5 years ago. So now it's just probably a good time to put money into a Roth if you have that option, just generally. Our current tax rates are a result of the Tax Cuts and Jobs Act that reduced tax rates in 2018. These lower tax rates are supposed to expire in 2025, so the rates could go back up in 2026, or they could be made permanent, or the whole act could be repealed and rates may go up sooner. I mean, we really don't know what's going to happen. Like anything could, like literally anything could happen. But all we know is that rates today are low, and that just opens up some interesting planning opportunities.
It's
Wow.
important to remember that the government just spent billions of dollars
Yes.
on CARES Act. So somehow that money is going to come from somewhere.
It's got to come from somewhere.
You know, we've been talking about building wealth and investing, but obviously another really important aspect is to make sure that you have the proper insurance. Donna, what do you think about life insurance, long-term care, umbrella? Can you talk a little bit more about insurance?
Yeah, insurance is truly risk management, and it's something that if you're going to spend the time and effort and build a financial plan, what is the point of building the financial plan if you don't have the foundations to support that? So, Sophia, can you go to the next slide, please? Okay, one more. All right, perfect. So at this stage in life, your children may be a little bit older. They may even have gone to college and maybe finished college at this point. Maybe you've gotten married. You may want to reevaluate to see if life insurance is still something that's important. When your children or dependents, not necessarily children, but when you have dependents that are younger, life insurance is truly very important at that time. But as they get older, you want to see if it's something that is still important because it is an expense that you're paying every year. The other thing to consider at this point is, does your situation require permanent life insurance? There's two types of life insurance. There's term life insurance, and then there's permanent life insurance. To put it simply, term life insurance is like car insurance. You pay every year, you have the coverage. You pay and you have the coverage. You don't pay, you don't have the coverage. And that's it, very simple. It's much cheaper usually than permanent life insurance, where you pay and there's a portion of it. You pay a lot actually relative to term insurance, but there's a portion of it that essentially goes into a savings account, and it's being built in the insurance vehicle for you over time. So while permanent life insurance may not necessarily be the best bang for your buck, if you're just looking for coverage because you've got young kids at home, they can be a very powerful gifting and estate planning tool. So take a look at your situation, review with your attorney and your financial advisor to see if maybe permanent insurance is something that would be important at this time to consider. Umbrella insurance is something that's very common, especially in California. Sometimes you see it as called excess liability insurance. It's typically good value because it covers limits beyond what your car and homeowners insurance covers. As we live in a state where everyone seems to be very litigious, and you just don't know if you have all of your bases covered, it's probably a good peace of mind to get some umbrella insurance. They're typically sold in increments of $1 million, $2 million, $3 million, and you can get that through your homeowner's insurance policy. And then one more, Sophia. Long-term care insurance. This is a question I get pretty often. There's really two types of long-term care insurance. There's the traditional long-term care insurance, was what most people are asking about. The problem with it is it could be very cost prohibitive. So it depends on your age and your health, but usually the people that are looking for long-term care insurance at that point is probably quite expensive, to the point where you're wondering if it's even worth it to get this insurance. The US median daily cost for a private bed in a nursing home last year is about $280 a day, which is over $100,000 a year. This number obviously can fluctuate based on where you live and the type of services you're looking for, but I have had clients tell me that these numbers definitely look right, especially in California. But the biggest problem with people, the biggest pill to swallow for people to buy long-term care insurance, besides the fact of cost, is they feel like it could be a big waste. What if I pay and pay and pay for this insurance, and thankfully, unthankfully, probably thankfully, I pass away from a heart attack? Then I never had to use nursing home facility. I never had to use any of these benefits. So it just seems like it's a wasted premium that was never used, and it was really expensive along the way. And so that's traditional long-term care insurance, and sometimes it could be good, but those are usually the concerns that most people have. The second option is what we call an asset-based long-term care policy. These are fairly new. I would say I see them, they probably started somewhere between maybe 10 years ago, and it's starting to become increasingly popular. How it works is it's an insurance policy, and it's typically funded via a lump sum, or like a 5-year pay or a 7-year pay. It's usually like some finite number that you guys discussed ahead of time. And it can be used as life insurance. It can be used as long-term care insurance. So it can be used as either. So the problem with I pay, and I passed away from a heart attack, that issue is not, that's covered in this case because it'll pay out as a life insurance policy. Now, because it's really more designed for long-term care insurance, you can see that the multiple for triggering event for long-term care is going to be higher. So for example, let's say you have a policy, and based on your age and where you live and the terms that you're looking for, you put $100,000 into this policy. If you have triggering events and you qualify under long-term care definitions, essentially you'll have $400,000 to $700,000 worth of benefits used for long-term care. If you did not use it for long-term care and you passed away from a heart attack, then that $100,000, it'll come out as a death benefit to your beneficiary. So you put in $100,000, maybe they'll get somewhere between $150,000 to $250,000 as a death benefit. So for some clients, this may be an easier pill to swallow because it's a finite number that they pay. It's not an annual premium that goes on indefinitely that may or may not be used, because it can be used either way. And if you change your mind, usually there's like a 5, 6, 7 year surrender period, but it is refundable. So if you decide you put $100,000 in and say 7 years later, you're like, you know what, never mind, I don't need it, I don't want it for whatever reason, you can cancel it and get your money back as well. So there's two different types.
Well, those are very good strategies, and definitely life insurance is so important. From an estate planning perspective, one of the strategies that we use is life insurance, and we can make the trust be the beneficiary on these life insurances, so that something happens to you, the funds go into your trust, so that it can take care of expenses, anything related to your estate, to provide for your family, your spouse, your kids, but managed by the trust. You see, when you have a beneficiary on these insurances, it goes straight to that beneficiary. It won't, you know, even if you have a trust in place, if the beneficiary is a different person, it goes straight to them. So sometimes we have, as part of the estate planning process, we look at, okay, who's the beneficiary? What's going to actually happen? Is it better to put the trust as the beneficiary? It may or may not be, depending on your goals. But of course, having that estate plan is going to be crucial. You do all these things to build and maintain your wealth. Something happens to you, whether you're alive but incapacitated or you're not here anymore. You want to have the proper trust or estate plan in place so that you can maintain that and, of course, pass it on to your heirs. People ask me, well, then why do I need an estate plan? Doesn't my spouse just get everything automatically? That may or may not be the case, and it really depends on how these assets are titled and characterized. So in California, we're a community property state. If you had any assets during marriage, yeah, it might go to the spouse upon your passing. Even if you don't write anything down, you still might have to go through a little bit of a court procedure to do that. But that's generally how it goes, community property to the spouse. But if you have an asset that's separate property, a property that you had before marriage or received by inheritance, it might be distributed a different way. So that's something to think about as well. Generally, the main point with estate planning is to avoid going to court. And if you have these investments and the beneficiary, you didn't designate anyone, or the title of your house was just in your name and now you're not here, it has to go through that probate court system. And there could be ways around that. In California, probate usually is going to take at least 1 to 2 years, and it can be quite expensive. Guardianships, just going to touch on that, is if you do have children under 18, you do want to have some estate planning in place to name guardians. Because at 18, they might get everything. Before then, the court might hold it in a guardianship court provision. Also, something to consider with an estate plan is, everyone over 18, they're technically an adult in the eyes of the law. So they do at least need a will, a power of attorney for finances and for healthcare. Especially right now with, the pandemic and these COVID situations, healthcare documents are going to be very important, including an advanced healthcare directive. We did talk about that briefly. If you do have any questions more about these estate planning documents, of course, I'd be happy to talk with you about that. Most importantly, just review your estate planning documents or set them up if you haven't already, because I tell my clients, like, if you're in it, it's too late. Like you won't be able to plan or prepare any documents. If you're alive, but you're in a coma, you have dementia, you're in a situation where you don't know what you're signing, then you won't be able to make any documents. So, and Yuri, as you were mentioning with the tax changes, just review your trust, your estate plan, make sure. And if you do hear that there have been changes in the law, then it's good to also review the trust at that time as well. All right, Yuri, do we have any questions?
No, we don't.
Okay, great. So go ahead, Donna.
I will say one thing. I'm glad you pointed out that children over the age of 18, they should have some type of a will, because this is not my client, but I have heard of a client, one of my colleagues, where their child was, I don't know, maybe like 19 or 20 or 20, some young adult, and got into an accident and was in a coma. And the parents could not help him at all. They could not make any medical decisions. The doctors will not release medical records. They will not let the parents know what's going on. It was a really difficult time, especially as this drags on, because comas drag on for months and months. They went to court and such, all because he was over 18. I don't know what's so special about the age 18. When I think about that, it's so sad to me that parents of like a 19-year-old could not access any of his medical records and cannot help him make any decisions because he's over 18 in the eyes of the law.
Yeah, I mean, that's unfortunate, but I mean, they're technically an adult, and what if the child didn't want the parents to know about these things, And how do they know, like, who's going to make a decision for them? So we need to write it all down, because you're right. If you don't have it down, the court can decide. And the court is the only one that can, that has the authority to make those decisions. So it's really important to have these in place in advance. And, you know, maybe we never use them, right? So hopefully,
Right.
you know,
Best
maybe,
case scenario.
yeah. But if we did need to, of course, it's important to have.
Yeah. Well, it looks like we're right about on time, and I don't see that we have any questions, but as usual, feel free to email us any questions that you may have. I want to thank everyone for their time. As usual, we really strive to provide content that's worthy of your time. We know we are all very busy, so we do appreciate your time. Our next event will be the last part in our series, Financial Advice Throughout the Years. It'll be on Friday, October 16th at 12 p.m. We will still have the three of us as panelists, and we will be discussing the next chapter in life with aging parents. We post all of our events on Facebook, on the website. So as usual, please feel free to invite your friends to join us, RSVP, and join us as well. You will be receiving a survey shortly. Please, please, please let us know how you like these events, what areas we are able to improve. Any questions? This is the feedback that we're looking for, especially as we're doing this virtually. We can't even see you guys. We have no idea if you guys are even, if this information is even helpful. So please respond to the surveys to let us know any feedback you may have. We hope everyone stays safe and healthy. Have a great weekend, and we hope to see you guys soon. Thank you very much.